Welcome to this conversation on CFO Chat. As always, your front row seat with the Chief Finance Officer. Anytime a corporate action has happened, you have all the detail and lowdown here. EABL HY earnings are out. We are privileged to have, as always, Risper Genga Ohanga. Welcome on set.
Thank you, Julian.
Karibu sana, Risper. The HY numbers, I would say, strong cash flow statement, strong balance sheet, income statement. We have a number of questions there. How would you characterize the 6 months ended DEC 23?
I think, Julian's, we are proud of what we've delivered considering the environment we've operated in. If you look at revenue, we're up 16%. Very strong performance in very tough times where we've seen consumer incomes reduce. We've seen people struggle to prioritize what to spend money on. So we're very proud of a 16% growth in income. From a profit perspective, we are equally proud. If you look at our operating profit before the impact of FX and interest costs, which are really a construct of the macro environment in which we are operating, that's actually 6%. Because whilst we've had pressures of inflation on our cost of goods sold, we've managed our costs very well, and we've dealt with, we've continued to invest in our brands. So we're very happy with the shape of the income statement. We do see the impact of the macros, as you say, the combined effect of foreign currency depreciation and finance costs brings our profit after tax to minus 22% compared to the previous year. And if you look at the depreciation of the currency against the pound, we're nearly 37% year on year, and against the dollar, we are 27% depreciation year on year. So you're seeing that in the numbers, as well as the 182-day T-bill is 600 bips up. So you are seeing that in the net finance costs as well. The other thing we've weathered strongly, we're still concerned about it, and I know we'll touch on it, is the advance payment of excise, which has a knock-on impact on our finance costs.
I see. Barring the COVID shock in F20, I was going back and I realized that it's only in the half year ended December 2017 that we had a decline in your net earnings. Just give us more color around the FX exposure that EABL has and how it has manifested in the 2.3 billion FX losses.
So the FX is twofold. One, if I look back 2 years ago, we were sourcing a lot more inputs locally. But because of shortages, we are having to import a number of things. The primary one is ethanol. Whilst we were sourcing nearly 100% ethanol locally, the supply has dried out in Kenya, and now we're having to import that, and that's a big bill covering nearly 50% of our business inputs. So really having a huge impact on the FX number. Also, when you think about our imported spirits against the dollar, we are importing those in pounds. Pound depreciation against the shillings even worse, and we saw that really coming down aggressively between October and December. And if I compare year on year, December 2022 and December 2023, that's a 37% depreciation. So you're seeing that coming through the numbers. You can price it, but you also don't want to price yourself out of the market and kill your volumes entirely to where you cannot cover your costs. So it's a very tough trade-off, but I think we have done the right things, controlling what we can control and what we know will pass in the cycles of macroeconomics. We are weathering those quite strongly.
Okay. Risper, we've had this conversation before, and whereas we can say we had challenges on the income side, when I look at your cash position, very robust. And for you to slash the dividend as you have, maybe you can give us some thinking around it, because I'm sure shareholders are really thinking about this.
Yeah, I think, we always, as I say, put ourselves in the shoes of shareholders as we think about decisions such as dividend, and even as we think about the long-term future of our business. So we're very proud of very strong cash generation, 5 billion above last year. We generated 19 billion in cash from our operations, which is extremely strong. And compared to the same period last year, our cash and cash equivalents are 6 billion up. So we're holding 10 billion, which is 6 billion higher than December 2022. Having said that, the twin problems I've touched on of FX and interest costs are things that we have to deal with. And when we think about dividend, we think about two things. One, how do we secure the business for the future? And therefore, it becomes very critical that given the rising interest rate environment, that one of the key actions we can take is to reduce the level of debt that we have. You've seen long and short-term debt, excluding ODs, has come down by 6 billion. So we're paying down that debt in order to cushion the business against the impact of finance costs. So when we think about the dividend decision, we weigh that. We say, do we have any big capex? No, and you will see our capex is down to about 6% of net sales value. So we have really prioritized our capex, and therefore we've also had to prioritize the dividend to say, can we secure the business for the future? Prioritize the payment of debt to secure the business for the future. I think we're only halfway through, so we will see how the second half comes through, at which point we'll be able to make better decisions. But at this point in time, the volatility, especially on the interest rate side, means that we need to continue to conserve cash, pay down debt, and weather this tough period.
How do you respond to those of us who feel that even pre the wild depreciation of the shilling, it looks to us like EABL is increasingly opting for a more conservative dividend stance from a payout standpoint?
I think we aren't, and we've consistently, we planned this over a 5-year horizon. So through COVID, you will know that we invested. We invested in Uganda, and we've seen that growth come through. We invested in Tanzania, and we're really excited about what we're seeing in that market and what we will be able to do. And I think you know that it's very important that we are diversifying our income sources. So we've done the right things from an investment perspective. And investments means that total shareholder return, which is dividend, but which is also profitable growth, continues to grow sustainably. So I think through the horizon of the last few years, what you've seen here at the microbrewery, it's really important for our future in terms of quicker innovations. So we have taken a slower stance simply because we were investing for the future. Those investments are the ones which are ensuring we can deliver 16% growth. So otherwise, we would have been having a more challenging performance today. So we are not. We look at it case by case. It is definitely driven by each year's performance. It's also driven by the macros and how we make sure we insulate and secure the business for the future. So we continue to think a lot about our shareholders and how we make sure that we're growing the business sustainably, and how we also give back to them, both from a dividend payout but also from a sustainable profit growth. So I think we're weathering a tough economic season, and that's reflective of the decisions we're making.
Some forward-looking questions from me now, Risper. One is that how do you go about margin expansion given what we are seeing in your cost of goods? Because clearly, I mean, the inflationary pressures are really weighing in, not just on EABL, but every other business. Yeah.
I mean, there's a number of things we employ. When I look at our income statement, inflation was just about 4 billion, 3.8 billion to 4 billion of inflation hitting our numbers. And we do a few things. One, we look at productivity. So we look at every single cost and ask ourselves, can we do it a different way? Can we make it more efficient? What are the things we can do to bring down our costs? And we also look at recontracting different sources of inputs. So we're constantly doing that. And from that 3.8 billion, we're able to bring in about 3.3 billion of savings, which if we didn't bring, would have had an impact on the bottom line. We also take price when the inputs are high, like what we're experiencing with ethanol. We have to take price, and that is a tough decision always. But you do have to cover your costs, and we've seen that across all industries. So we manage by price, we manage by productivity, and we are consistently also looking for new revenue streams, whether exports or local markets. You've seen our new innovations coming in and doing very well. So we are consistently on our search to grow the top line, mitigate the cost line, and make sure that we have a good outturn from a profit perspective.
I see. A year and a half ago, we sat down and I asked you whether, given the trends we are seeing across peers like Uganda and Tanzania, perhaps it was time for EABL to kind of deconcentrate from the Kenyan market and play more in those spaces because of the environment. That time, the focus was on regulatory overreach. But here we are, where the tone in the briefing this morning actually suggests to me that maybe we are finally thinking that way. Yeah.
I don't think so. I think what we've always said is that two things. One, economies go through cycles, and you have to weather it. In Africa, we've seen these cycles, and you have to weather the storm. Otherwise, you will make short-term decisions that are quite painful. So Kenya still remains the biggest part of our business. And I always say we can't fold our factory and take it to Uganda. Yeah. We've got a factory here. We are a significant player in this market. We're one of the largest taxpayers. We work with 60,000 farmers, 250,000 retailers. We're big. And this market is important to us. And it's important that we weather the challenging times. Having said that, and this didn't start now, we have expanded our revenue sources regionally, whether it's South Sudan, Rwanda, Uganda, Tanzania. Those are coming through from the investments we've made. We think it's important to diversify our sources. However, there's no intention to deprioritize Kenya. We still think it's a market where we are going to continue doing business, and we are so integral to it that that will not change.
Okay. Finance Act 2023 amended the Excise Duty Act and provided that alcoholic beverage manufacturers like yourselves would have to remit excise collections within 24 hours. What did this mean, one, from a compliance standpoint, and two, from a cash flow position as well?
I think it's extremely problematic on both fronts, and we've been quite open with the policymakers in saying this is extremely problematic. Administratively, it means you're reconciling your accounts daily. You know, when we had it monthly, you close your books, you reconcile your numbers, you're sure you've done the right number, the right submission, you can reconcile it to your general ledger, and you're correct. Now you pay the excise, which is a consumption tax. You're now paying it the minute you remove it from the store. You don't know whether you've sold it or not. Next week when you sell it, now you start doing adjustments. It's chaotic. And I also don't know how it is on the revenue authority side, because you're just not built to do accounting like that. So it's chaotic. So you now have a whole army reconciling and correcting. And because you don't want to underpay and be hit by penalties, you're constantly paying ahead and then trying to get back and rebalance the numbers. So it's extremely administratively challenging. On the cash flow side, again, extremely cumbersome. We sell on credit. As I said, we have 250,000 retailers out there. The distributors who buy from us buy on credit, sometimes 30 days, sometimes 45 days. But now it means the minute I take it from the store, even before it reaches the distributor or the retailer from whom the customer will buy, I have to pay the tax. So I'm prepaying all of this. And that means a hit on my working capital. So by the time I collect, I will already have paid, which means I'm consistently in a borrowing position from a short-term perspective. And that's just, in a rising interest rate economy, it's bad for business. And we really hope that the policymakers will do this, will look at this. It's not increasing the amount of collection, so it's a zero-sum game, and it needs to stop.
I see. And in light of that and the working capital constraints it's creating is, so what conversations are you having with banks around this?
Well, you know, it's challenging because, you know, it's a business opportunity on their side. So you do have to engage with them to make sure that you have the money to pay the taxes, whether you need to draw into your headroom and borrow short term and then regularize as soon as you collect. So that's the kind of cycle we are in, which is not how you run any normal business. You know, you will collect and pay your bills as opposed to prepay your taxes before you even make a sale. So I think it's one that, I mean, the intent was to deal with the illicit. I don't think it's had any impact on them, and it has actually punished the compliant taxpayers even more.
I see. Still on the regulatory environment, Risper, the medium-term revenue strategy proposes a shift in excise on alcoholic products to move from the system we have currently to focusing on alcoholic content. And I shudder at the thought of what this would mean for EABL. I'm curious as to how you think about this and how you're potentially preparing for it being rolled out.
It's very concerning. One of the things we've always said is, from a Kenya perspective, it's very important for policy to be predictable. And that's something we've consistently said. There's been a move to try and bring that predictability, and we see that. But actions like this, you know, are quite detrimental to one who has put up a plant and a huge investment to manufacture product. So we think, one, demonstrated time and time again that the increased excise taxes don't increase tax collection. All it does is push more people into the illicit trade, and reduce taxes, reduce legitimate business. So we're in intense conversation to have this looked at, to have it really thought through, because it would have a huge impact. It would grow illicit, as at last year, the study that we did showed that illicit alcohol is 56% of the market. So it's bigger than the formal market, and moves like this make it bigger. So I think it needs to be looked at again, and also in the vein of a predictable tax policy means such shifts can be quite damaging for business.
Okay. And as we wrap up this conversation, Risper, your net finance costs up quite a bit. I know you've already touched on the borrowing side, but maybe just speak to us in terms of how you are handling your leverage position as a business.
Very happy with our leverage position. Our net debt to EBITDA is at 1.23, very, very decent. Our current ratio is well above 1, fairly decent. So we're very happy with where our ratios are. They're within the board targets from a leverage perspective. Having said that, we recognize the challenges that come with the rising interest rate environment, and therefore the actions we're taking now are to mitigate those quite quickly, bring down the debt, not because we can't handle it, but just because the rising environment does make it more expensive. We're fortunate to have fixed the MTN for the 5-year period at 12.5%. So that gives us some level of cushioning. But well, we kind of saw this coming. So I think we are fortunate with that. But for where we can manage it down, that's the biggest step we're taking, is manage that down quite quickly and mitigate against the interest costs. And we're making good progress. 6.1 billion down on repayments in the half is quite good. Yeah.
All right. Final question. We are consistently talking about consumers trending downwards on their consumption. I just wonder, looking into the remaining half of the year, what would you be doing strategically? This time, at least compared to last year, we've seen volumes are up. How do you sustain this?
Well, we're very happy with that. So, you know, we've been supported, obviously, because the annual inflationary increase on finished goods has been taken out. There are excise increases on inputs which feed into the final number, but you know, you fight one battle at a time. But having said that, one of our big things is really working on innovation. And today we've hosted you at the microbrewery, which is playing a big role in our innovation agenda, tapping into different customer tastes and preferences and giving them products that they will buy and that they will enjoy. So we've seen the massive rollout of new innovations coming out of EABL, really vibrant, really exciting, really tapping into new customers or even existing customers. So we're doing everything we can to grow our top line. We are also, as I said, we are not cutting down on our investment behind brands, so we are sustaining the ratio of advertising and promotion spend to build the brands, because that's what gives us the sales volumes. And we're innovating for each and every customer so that whenever they have a choice, they choose us. So I think that's working. We keep at it, we keep driving and pushing, we keep listening to the customer, and we keep responding quickly. And I think we're in for exciting times, despite, you know, some of the bigger macros that we're facing.